Hey folks, welcome back to the channel. And if you followed my channel for a while, you probably know that Alphabet is going to announce earnings this upcoming week on February the 2nd. So let's talk about what we can expect for Alphabet's fourth quarter and how to position yourself properly, which will depend on your time horizon. So let's first take a look at what Alphabet has done previously with its earnings. Most of the time, the company did beat forecast earnings per share, except the last few times during 2022, especially the previous quarter, where it was expected to make $1.26, but they actually came out with only $1.06. So that was a huge miss. And the stock sold off 9% the day after the earnings came out. So the question is this more recent trend of missing expectations going to continue into this quarter? And I think there is a strong case to be made that there is, because Alphabet did mention last week that they are laying off 12,000 people. Now, why did they choose to make the announcement just a couple of weeks before releasing earnings? Could it be because they know their financials are worse than what investors expect? So they want to throw a bone and say, like, look, we're doing what we can to cut costs and improve profitability. So that could be what they're doing, but of course, we won't know for sure. The other thing is that the Department of Justice has gone after Google again, and they basically want to break up the company because they think it's too big. Depending on how this plays out, there could be some short-term negative impact to the stock. So in the short term, Alphabet stock may go lower. But as mentioned in previous videos, I think Alphabet is one of the better stocks you can buy long term, because even though it has some problems right now, I think these are all temporary in nature, and the company is still expected to grow over the next 5 or 10 years, especially its cloud business. Right now, the three biggest players dominating cloud services are Amazon, Microsoft, and Google. So chances are the cloud is going to get bigger, and Alphabet is one of the top companies that can benefit from that. Last year, growing by 47%. So we'll see what happens this year, but it's probably going to continue growing at a pretty fast pace. So I understand why the stock is down so much. This is a 5-year look at the chart, and this is the 1-year chart. But I think it's undervalued. And not only that, but unlike some other tech companies, if the economy slows down or there's a big recession, I don't think Google shares are going to drop as much as the overall market, because the biggest component of their revenue is through search and advertising. And I don't think search is going to diminish over the next year or so. If anything, as more people use the internet, they're going to use more search. Now, businesses might pull back their advertising spending, but I think any decline in revenue will be short-lived, as once the economy picks back up, so will the advertising business. And it's not just me who thinks like this. Alphabet is in the top 5 components that make up the S&P 500. So if we just look at the top 5 companies in the index itself and see what analysts have to say about them, these are the price target ranges that I've gathered for all 5 companies. Using Refinitiv data, we can see that Wall Street analysts believe a year from now, the lowest price that Apple may fall to if there's a recession coming, which a lot of people think it's coming, myself included, then Apple may fall to 122, which is a 16% decline from its current price today. Microsoft will drop 14%, Amazon could drop down 21%. Berkshire Hathaway is actually going to do okay, with the lowest estimate being about 6.6% higher than what the stock is trading at. But then look at Alphabet. Even the lowest price target is 9% higher than what it is today. And if you take the medium price target, which is this column down the middle, then other than Amazon, which is highly volatile, Alphabet is going to give you the best chance of getting a higher return, because the stock is at $100 today. It can go to $121 a year from now. So if you want to buy a stock that's not going to lose you too much money if the overall market goes down, and you still want to capture some upside if the market goes up, then I think Alphabet is a pretty good play today. But the thing is, earnings are coming out. So what can you do to prepare for that? Well, you can buy half a position in the stock itself. For example, if you want to buy 100 shares of Alphabet, then you can start with buying 50 before earnings come out, and then you buy another 50 after earnings, so you're kind of hedged that way. And if the stock goes up, then you just average up. If the stock goes down after earnings, then you can average down. But you can also use options to hedge your strategy. So that's what I'm going to be showing right now of something that I would personally do. All right, so here we're looking at the daily chart for Alphabet. I'm using GOOG as the ticker. So if I do some options with this, there's no conflict with my weekly options challenge for Google, which uses GOOGL. So with earnings just ahead for next week, just using a channel here, we can see that Alphabet has been going up lately for the last several weeks. So if momentum continues, you would expect the stock to go up. However, there's a few things to watch out for. One is that Alphabet is now entering this supply zone here, and the price movement can get very volatile once it's in here. If sentiment continues to be bullish for Alphabet, then it can easily go over the $105 level and can go much higher. However, if earnings come out lower than expected, and especially if it's accompanied by lower guidance for the next couple of quarters, then the stock can easily get rejected. So you have to decide if you like Alphabet as a long-term investment. And if you do conclude that it is worth holding long-term, even if there's a lot of price fluctuations in the short term, then you can use options to kind of hedge your downside risk, but also take advantage of any upside potential in the short term in case earnings come out really strong. You can buy a bull call spread, which will give you the option to buy the stock if it goes higher. So for example, if you buy a call at 105, which will cost you about $138, but if the stock goes all the way to 110, then you can make that $500 difference minus your initial cost, which would be a big profit. Now, because the price of just buying the call itself is kind of expensive at 138, what you can do is also sell the next strike up, which is 106, and that way you're not paying 137 or 138, you're only paying the difference between these two, which is only going to be like $25 or something like that. Now, at the same time, you can sell a put option, and that way you can earn a premium, and you can use the income you earn from the put option to pay for your call spread. So in reality, it might look something like this. I'm going to have my call spread starting at 105, and that's because this is the top of the supply zone, meaning if earnings come out really good, then the stock will probably pop to 105 or over. And then I'm going to sell a call option up here, so that'll be a short call. That's going to reduce the amount of money I have to pay for this strategy. And then down here, I'm going to have a put option. Now the put is going to depend on fundamentals because I do expect Alphabet to continue going up over the long run. Right now, the basic EPS, earnings per share, is $5.09. So I'm going to try to figure out what is a reasonable multiple that I'm willing to pay, even if earnings come out really bad. Because if it's just 1 or 2 quarters of bad earnings, that's a temporary thing. If Alphabet's business model continues to be strong over the next 2 or 3 years, the earnings will go back up. So looking at a 5-year history of Alphabet's PE ratio, the 5-year average is 32, but I want to be paying a discount for it. So if I look at 2022, which was a pretty bad year for Alphabet, I can see that the lowest PE ratio that the stock has dropped to was about 17.5 because it's in between 15 and 20. And it seemed like when the PE ratio dropped to that level, there was a bounce up each time, meaning a lot of buyers came in and pushed the stock higher, pushing the PE higher as well. So I'll just round this to maybe like 18 times PE, which is lower than the S&P 500 right now, and it's much below the 5-year average of Alphabet. So using an 18 times PE ratio multiplied by the current earnings per share, that gives me about 91.6. I'll round that to 92, and this would be a short put. Okay, so now let's talk about dates. Because Alphabet's earnings are coming out next week, if I go to February the 3rd, you can see that the IV is relatively high. This is at 50.6. This week, it's at 21.6. And then the following week, ending February 10th, is 41. So February 3rd is the highest implied volatility, and that is to be expected. But what that means is we can take advantage of IV crush. So even though the IV is really high right now, by the morning of February 3rd, which is the day after earnings, this is going to drop a lot. And when you have implied volatility dropping, it also means the value of your options is also going to drop. So because of that, I'm going to have my short put position expire by next Friday, which is right here. And I want this to expire quickly to take advantage of that implied volatility crush. Now, in terms of my call strategy, I want to be using a longer duration option. So February 17th is the 3rd expiration week for February. So that's when a lot of options are expiring. And it's 21 days away. So that seems like a good time for it to expire because you don't want it to be too long because then the options will get pretty expensive. And I don't want it too short because let's say the earnings come out and the stock jumps up to 104. Well, if it expires the next day and the stock stays at 104, then my call options, both of these, would expire worthless and I would have lost all my money just for the call option. But if I choose a further out expiration, like February 17th, then it gives the stock more time to climb up. and hopefully eventually go past 106, and then I can make basically $100 minus whatever I paid for the strategy. So looking at the option chain, I'm going to sell the put option first. So going to February 3rd, if I go to $92, I can make about $40 here. And there's only about 11% chance from now until next Friday of Alphabet reaching 92. Okay, so I'll try to sell it for the ask, which is 41. Okay, so that's been submitted. Now I'm going to jump over to February 17th, and this is where I will be buying my call spread. So here's a 105. I'm going to buy this one, and I'm going to sell the 106 call. So that's going to be about 33 cents. And in this case, instead of trying to get the ask, I'm going to try to get the bid price because I'm buying this. So I'm trying to bid as low as I can. And since it is buying a spread, the margin impact is 0 because there's no risk of losing money other than the money that I'm paying right now. By the way, ideally for the $92 put, the short put, you want to put the trade on pretty much right before earnings come out. So earnings are released in the afternoon of February 2nd. So during the trading session on February 2nd, like maybe right before market closes, that's when implied volatility will be very high. And that's when you can go into the February 3rd expiration options table. And it won't be 7 days until expiration at that time. It'll be like 1 day before expiration. And then you want to sell the 92 or 91 or whatever put. And then your option premium should be much higher than what it is now, assuming the stock price is still at 101. But that's how you can maximize your IV crush. But I'm just doing this now because I won't be putting out another video until the following week.
Autofilled.
Okay. If earnings come out and Alphabet drops, as long as it doesn't drop below $92 next week, then the options I just put on does not lose any money because I'm basically break even for that. And then at that time, you can buy Alphabet at $92 or $93, $94, a little bit higher. But that's better than buying the stock right now because if earnings are bad and the stock drops, then you would have bought the stock higher than what you could have bought in at. Now, if earnings are good and the stock goes to 105 or higher, then at any time before February 17th, you can close your position for a profit, most likely, especially if it goes over 106. So that's how you can take advantage of potentially positive earnings without having any direct exposure to the stock itself. Now, the only downside is if earnings come out really bad and before February 3rd, next Friday, which is when the short put expires, the stock drops to let's say back down to this level in the mid 80s, that would be really bad because it means I would have to buy this stock for $92 per share, even though it would be worth much less in the market. However, that's still better than buying the stock outright today at 101. So it's not a great situation, but it's not the worst situation because if the stock is going down to 85, then it's better to buy it at $92, the strike price of the put option, than to buy it at $101, which is today's price. And that's why you have to be long-term bullish if you're using this strategy for any stock or ETF. Because even if the stock drops down to like $86, which was the previous low over here, you have to be confident in your analysis that this is just a short-term drop in the price of the stock and that eventually when the market picks back up, the stock will go higher and you can average on the way up. So that buying the stock at 92 compared to 86 isn't going to make that much of a difference in the long run when you look at it 2 or 3 years out, when the stock is probably going to be up like 20 or 30% from today's prices. Okay, so we have a $92 put that I am short. That's why it's a -1 here. And right now it's worth $44. So I'm currently losing $7 on it, but because of time decay, I expect the market price to drop to 0 eventually, assuming everything else like the stock price stays the same. And then I also have a bull call spread over here. This time I have a positive position because I paid for this and I'm losing $5. I paid $37, but right now it's around $31.80. In this case, time decay works against me. So if earnings come out better than expected and the stock goes up, then my plan is to basically close this position and make a profit. Whereas for my short put option, I expect this one to just expire out of the money. So hopefully that gives you some idea of what you can do with options. We'll have to see what happens this upcoming week. If the stock moves up, then this will be a profitable option strategy. If the stock moves down, then that's just better for long-term investors because we can buy in at cheaper prices. So either way, it's going to be pretty interesting. Good luck with all your investments out there. Thanks a lot for watching, and I'll talk to you in the next one.